Well, September is generally unkind to investors. We saw that on full display last week, where we saw a number of the averages break below their short-term moving averages. The NASDAQ, the S&P, as well as the TSX are down so far in September. Let's bring in Carol Schleif. She is the Chief Investment Officer at BMO's Family Office. Carol, you manage money for the long term, not just for these short moves that we are seeing. So, help us get away from our myopic view about, the Fed. What are they going to do? What are these data points telling us? And how are you thinking about the opportunity set in front of you?
It really is a difficult month because there's a lot of the historic pullbacks that have happened in September or October. So people come into it a little bit psychologically prepped to be susceptible to those headlines. But we encourage ourselves and our clients to really not focus as much on the headlines, to try to get through the noise. There's a lot going on this month. There's actually a lot going on this week in the tech industry with the U.S. House back in and trying to pass appropriations bill. Everyone geared up for the Fed to meet next week. So we really do try to focus on those longer term opportunities and keep a balanced approach to risk, such that, there were a lot of bears at the beginning of the year, assuming we were going to see a recession in all of North America, and we haven't seen that. We've skirted it. Our opinion was that you most likely were going to see a softer landing, if perhaps not any sort of pullback dramatically in economic activity. And so within that, we wanted to make sure that we have a toe in some growth areas. We also are taking advantage of the fact that short-term rates are high. So we've got some fixed income in the portfolio taking advantage of that. So we're looking at a lot of different areas, trying to make sure that we don't get too over our skis in one camp or another.
Talk to me about that toe in the growth areas. Do you care about valuation? Does that stop you from getting into that area of the market? Are you trying to look at more structural themes? How do you put all that to practice?
I think we look at one of the areas that we really enjoy pursuing, if you will, is those long-term secular themes. And we've got a couple at play right now, not the least of which is what impact will AI have? It's hard to invest in the short run, but you want to make sure that the managers you're picking, the companies you're selecting are paying attention to AI and are figuring out how they're going to adapt their business practices and adopt it internally. And so there's that piece of it that you want to keep focused on. Valuation does matter, because if you buy at the wrong time, it can take an awful long term of a very long-term portfolio in order to make it right. And so we also tend to operate within ranges where, when things get overvalued in the short run, we might trim some to look at industries that are less unloved or less valued. And we actually really like to go where the consensus is very negative and poke around and see if we can't find some of those green shoots coming out of areas like that.
All right, like utilities and office real estate. Is that how far you're going on that side of the contrarian spectrum?
Probably not utilities. We've never been a huge fan there, and they're having a tough swim, if you will, against even short-term cash rates and short-term fixed income and some of the other areas. But definitely looking at, are there ways to play structured credit? Are there ways to play, how are the managers, the real estate managers that we're doing, looking at various industries? And a lot of the market, a lot of investors want to put real estate in, especially commercial real estate, into one big macro bucket. There's a lot of nuance in it. It's not just downtown commercial real estate. There's retail real estate. There's mid-level manufacturing real estate. There's lots of different aspects of that. And so we hire managers that are very adept at being able to navigate those nuances.
How are you viewing the pending IPOs, whether it's ARM, whether it's Instacart? I mean, for all the gains we've seen in the NASDAQ, it has not prompted a flood of IPOs to come and take advantage of that. This is going to be a real test of appetite.
Yeah, it definitely will, and it's something we're watching closely, because there's a combination of impacts. There's the, can we get the IPO market going again? But there's also the credit availability, and will the bankers step into that? Will you see the deals happen? And there's a lot of deals in the pipeline that are looking at at how well does the Instacart, how well does the ARM IPO take off? Is there some M&A? And you've got M&A announced overnight. And so watching some of those kinds of things in terms of does the exit market open up in a variety of fashions, a lot of us are watching that pretty closely.
You know, for all this talk about, where to be positioned and whether there's rotation, should we be going more towards value, the TSX can't seem to catch a break on either side of that conversation. How are you thinking about positioning right now? What's attractive, Canada versus US?
Well, I think we like to invest North American, especially given BMO's background as a huge Canadian bank. But I think there's a lot of interesting things too, especially in the industrial, the extractive side of the market, that undergirds one of our long-term secular themes, which is that in the U.S. in particular, the various acts that have been teed up over the last 3 years really position the U.S. to be doing one of the most substantial infrastructure and productivity enhancing builds that we've done arguably since we built out the interstates in the 50s and 60s. Takes a lot of minerals, a lot of mining activity, a lot of construction activity. Some of what's been a gating factor is actually not having qualified employees to work some of those industries. So we like to invest on both sides of the border.
All right, Carol, thanks so much for joining us with that perspective. That's Carol Schleif. She is the Chief Investment Officer at BMO's family office.
We've seen something of a rally, a catch-up in the shares of International Petroleum. We'll have a look at a comparative graph in a minute. There we are. Over 3 months, you can see it has been topping the TSX Energy Index, and we'll look at a longer-term chart as well. Now, the company is spending heavily on its Blackrod project, which will add about 30,000 barrels of oil a day. Currently, production is about 50,000. So this is a major development. We're joined now by William Lundin, Chief Operating Officer of International Petroleum, member of the distinguished Lundin family. So you're based in Geneva, but your grandfather started the company years ago.
Correct.
Yeah.
Yes, I'm based in Geneva, working at the corporate office for International Petroleum Corporation as the Chief Operating Officer. My grandpa, Adolf Lundin, was the founder of the Lundin Group, started the business over 50 years ago, has carried on through Lucas as well as his brother, my uncle Ian, and now through myself and my brothers.
So you have some production in Malaysia. Is it some production in France as well?
Correct.
But it's only about 7,500 barrels a day total.
That's right, approximately. Yeah. So we're doing just shy of 5,000 barrels per day in Malaysia and around 3,000 just under that in France right now. So we got a decent contribution from our international assets that we have, and they have Brent-linked oil, which of course is a nice benefit to have in the portfolio.
Right, it's a diversifier if Brent goes to a premium, etc. But the vast bulk of your production is in Canada right now.
Correct. The majority of our production is coming out of Canada at this point in time. We're doing in excess of 40,000 barrels of oil equivalent per day there, and about 33% of our mix is natural gas.
What will this Blackrod project? Oh, we've got some facts there. So Blackrod will add about 30k a day. It's an oil sands / thermal project.
That's correct. It is a oil sands project. We took a strategic decision at the start of this year to sanction the Greenfield Development Project, which hasn't been done in quite some time in the oil patch in Alberta. This asset has a significant amount of resource in place. I like to coin it as an elephant field. There's 1.3 barrels of recoverable resource there, assuming a 50% recovery factor, and we decided to do
1.3 billion barrels.
1.3 billion barrels. Just shy of that, and we decided to sanction phase 1 development of that. With it brings 218 million barrels of 2P reserves. So we're just taking a bite size out of that resource for a phased development approach, starting with 30,000 barrels of oil per day, which is expected to first oil to come online on the back end of 2026.
2026. Your market cap is about 1.7 billion, and the stock trading at about $13. Have you given investors any guidance on what cash flow per share they can expect this year, or is that a thing you actually do?
Yeah, for the cash flow projections, from a free cash flow projection over the 5-year horizon, we expect to generate in excess of $700 million in free cash flow, and that's less the development costs of Blackrod. That's assuming a $75 Brent price. If we're looking at a $95 Brent price, roughly where we're at today right now, we expect to generate $1.4 billion in free cash flow over the next 5 years. But what's more interesting and really underpins the decision of sanctioning the Blackrod project is for that ensuing 5-year period from 2028 through to 2032, we expect to generate anywhere between $1.9 to $3 billion in free cash flow, assuming $75 to $95 Brent prices. So a material growth project that's going to create significant value for the company.
And where will you sell that oil? Have you got plans for actually marketing that oil from Blackrod?
That's a great question. And the benefit of the Blackrod project is there's a major pipeline corridor about 30 kilometers away from the asset. So the crude will actually be flowing up into Edmonton, and Edmonton has a strategic benefit there because you have the ability to send your crude west with the TMX pipeline set to come on stream.
Let's hope
and
it's
also have
going.
optionality. Exactly. It might be a little bit delayed potentially as we're hearing some rumblings about that. But I think we'll be in good time by the time Blackrod comes on. I'm sure that pipeline will be in service, but we'll also have the ability to go south to the States. So very strategically located.
And financing Blackrod, how much will it cost roughly to get the first phase?
Yep, the capital expenditure estimate to first oil is $850 million USD on nominal basis.
Sure.
So it's, 850. We're going to fund that through the cash flow generated through the business. But what we've also done is last year we raised $300 million USD in bonds. That's fully cash collateralized at this point in time. We haven't drawn on them. It's a 7.25% coupon rate. And with current deposit rates at banks sitting in the bank right now, we're generating greater than 5% interest. So the cost to carry is actually quite low. And it's great to have that cash resource available, even though we don't need it right away.
Wow, the interest rate arbitrage worked out. I know that's not what you're about, but it's kind of a windfall.
Correct. And what was recently announced actually yesterday is that we intend to tap that bond. So we have the ability to go to $500 million USD, raise an incremental $200 million on that bond under the same terms. And that's what we're looking to do this week.
William, thank you very much indeed.
Thank you.
William Lundin, Chief Operating Officer at International Petroleum.
Well, in the car business, technology is changing the way we drive. Tesla, for example, is pushing ahead with autonomous vehicles. Technology is also impacting the insurance business. Definitive Financial, for example, which is the parent of insurance brands like Economical and Sonnet, recently launched a program that uses technology to track your driving. And that's part of its bet on usage-based auto insurance, a growing trend in this country. Rowan Saunders is the president and CEO of Definity, and joins us here in studio. Thanks very much for your time.
Great to be here.
So let's talk about this. You're using technology to track how much someone drives, and that ultimately impacts what they pay in insurance. Is that how it works?
That's exactly right. What we found is that consumers, there's a number of trends that are going on, and particularly when it comes to personal insurance, people want to have more control over the product they buy, the type of the product, and the ultimate cost. And there's a belief that if you're a better driver, if you're a safer driver, if you drive at better times, that should be differentiated. And that's the way, through this app, that we charge you based on your own personalized behaviors.
So it would measure, I would imagine, let's say over, because I think this is quarterly it changes, right? So it would measure just how much you drove, maybe versus some people. But how does it measure how safe a driver you are?
There's an algorithm in there, and it tracks a number of things. So there's things like the time of day that you drive, the routes that you take, your own personal behavior. So are you a fast accelerator? Do you hard braking? So those are the type of characteristics that we have a predictive algorithm, and that predicts your propensity for having an accident and a loss. And therefore, the safer you drive, you get to see those scores. And this is what's very unique about this particular product that we have in the marketplace, is you get to follow how your driving is scored. And if you're driving well, you can see your score improving, and you know you'll get a discount. On the other hand, if you're driving detours from that, then you get a warning.
All right. So putting it more in the individual's hand to make that decision, and to be able to do that through an app is pretty amazing. And yet I'm sure when people think about the fact that their phone is giving them directions in the car now, it's even reminding them when they shouldn't be on their phone when they're driving, technology has come a long way. At what point does this enter your business? When do you have to start thinking about technology to use technology for an offering like this?
Yeah, it's a great question. And I think that until you've built modern technology stack, it's very difficult to have these, let's call them innovation layers. And that's one of the things that Definity's done for some time now. As you know, we went through a journey from being a mutual company to a successful IPO. And as part of that, there was a big investment in technology. We ran a transformation program. We did a turnaround program, and that technology, which really has been in the hundreds of millions of dollars of investment, gives you a modern stack to then apply these more innovative features on. So you do need the core technology system in order to start moving to some of these more advanced and user-friendly or customized products.
Well, the auto example is pretty easy, I think, for people to understand. But from P&C to pet insurance, you're working technology into everything basically now? Yeah,
we really are. I mean, some of the trends we see is that whether you're a consumer, you want to have more control, you want digital interfaces, or even if you're an insurance broker. You know, we have a significant part of our revenue that comes through independent brokers. They themselves, too, need to interact digitally with their customers in addition to giving advice. And how efficiently they deal with us is really, really important. And so that's part of the benefits. One of our brands that we have is called Sonnet. It's the first and fully only digital insurance company in Canada. But that allows a consumer to spend about 5 minutes, answer about 5 questions. We do the rest through third-party sophisticated data, and you can bind online. That's a precursor to now the product Shift, which is the usage-based insurance app.
I'm curious as well, since when it comes to the claim process, I think people have gone through that in various forms of insurance. Does the technology get involved in that essentially too? Does it basically know now when people are making that claim, it can look through the data to actually inform itself and the company of that claims process a little bit more?
That part of the journey is progressing across the industry, and I think there's a couple things there. First of all, when you have, for example, this app in, it tells you enough about the speed of the collision, things like that. So that helps accelerate the process. We also have a digital first notice of loss process where you could simply take a photo of your car and email it into us, which increases the pace of adjudication. But we haven't completely digitize that process, because what we found is consumers don't often have these insurance cars or your house flooded or burnt, and you do want to speak in most cases to a human on the other side.
Yeah.
And we think it's really important for our claims professionals to be able to explain to you, you're in good hands, you are covered, this is the steps. From there we start to interject more of the digital process.
Yeah, it sounds like you're trying to bring the business to the phone where people are spending a lot of their life these days, basically.
Yeah, correct. Yeah, that's most interaction.
And I guess you alluded to the economy as well. Does this become a competitive advantage if I guess people are frustrated with just about everything they're paying for right now?
I think it is. I think one of the things that we see is certainly, we're in a period of economic uncertainty. We've got inflation. Is there a recession, ahead? We'll find out. The one point I would make that the P&C industry is certainly very recession-proof. People need insurance for your homes or for your cars in order to drive. So we're an industry that's quite resilient. But we are dealing with cost inputs. And I think when we think about this inflationary environment, on the one hand, some of our input costs are higher. When you think about cost of a rental car or parts or new car or building a new home. And those costs we've got to pass on to customers. On the other side, we do get an offset on investment income because our fixed income are rolling or maturing over into higher yielding income. And that's been kind of helpful for our business. So the net of it is consumers are more and more focused on their cost of insurance, and they want choice, they want easy interaction, and that's why some of these more digital solutions are gaining their attention.
Rowan, it's good to have you with us. Thanks very much for breaking it down.
No, you're welcome. Thanks so much.
Rowan Saunders joining us, the president and CEO of Definity Financial.
Well, the federal government is giving businesses more time to pay back their COVID emergency loans that were taken out during the pandemic. This is a request that we have heard from the Canadian Federation of Independent Business leading up to this. So let's bring in the CEO of the CFIB, Dan Kelly, for reaction. Dan, what do you make of this announcement from the federal government today to extend the repayment period for the CEBA loans?
Well, it sounds a lot better than is the reality. Sadly, they didn't extend the first deadline that businesses are panicked about. That's the loan to keep the forgivable portion. And that it was extended, in fact, but by 2.5 weeks. This is an 18-day extension to the loan period, not a 1-year extension. Yes, they did add a year to the ultimate repayment, to the final repayment deadline of January to the end of 2026. But businesses right now are panicked because if they don't repay the loan by the end of this year, they will have to pay an additional $20,000. And the government today gave them only 18 days of relief for that. This is too little and very late, super disappointing.
So that part was specifically carved out, that an additional 18 days?
Yeah, it is pretty surprising. When the reporting suggests, and the Prime Minister just said that there was a 1-year extension to the loan. And he's right, there is an extension to the ultimate deadline to repay the loan, even including with the interest attached to it at the end. But the repayment deadline that everybody is focused on is the one that's at the end of this year. And that was extended by a period of only 18 days. So January, they moved it for whatever reason to put it past the Christmas period, pushed it into mid-January. That's going to provide almost no benefit to small businesses. And this is why this announcement, I think, was designed to sound a lot better than, in fact, it really is.
Why do you think it was done in this way, Dan? I mean, I know you weren't in the room while the decisions were being made, but, if that's the part that, people needed that extra relief on, I mean, they're hoping to get the repayment or the forgiveness of part of that loan. That does seem like a significant miss.
It's a big miss. Look, it is good news that businesses will have more time. There are going to be loads of businesses that are not prepared to repay their loans by the end of this year. They will end up having another $20,000 tacked onto the loan, and they're going to have 3 years, not 2, to repay that $60,000. So that will help some of them that are facing that. But we've been pushing, and every business association in the country has been pushing to extend the loan deadline to keep the forgivable portion, and that one is changing by just a mere matter of days. I think this was designed to satisfy some angry Liberal MPs who are raising this. I bet you when they look at the details of what the Prime Minister has announced, not just the headline, there'll be a bunch of very unhappy Liberal MPs because we've been hearing from them in huge numbers.
Dan, I'm really glad we checked in with you to clarify some of those details there. Thank you so much for making time for us this afternoon. We'll continue to follow the reaction on that. That was Dan Kelly, President and CEO of the Canadian Federation of Independent Business.
Welcome back. As we've told you in our newscast, about 13,000 U.S. auto workers are now headed for the picket line, striking 3 major auto facilities operated by Ford, GM, and Stellantis. In the United States. It's the first time ever the union has struck against all 3 of the Detroit 3 at the same time. Here in Canada, Unifor, the Canadian Auto Workers Union, still in negotiations with one of the automakers here. For more, let's speak with our own John Ehrlichman. John, lots going on here all of a sudden.
And a unique situation where you have these tense times on both sides of the border playing out this way. We spoke earlier with the head of Unifor, which is still in negotiations right now with Ford. I'll have more on that in just a second, Paul. But in Canada, there was this desire by the union representing 18,000 workers to try to get something done to align more with some retooling that is currently taking place in a number of facilities in a market like Ontario. But now we have an environment where we can compare the U.S. to Canada. And obviously, people have been hearing about the strike action beginning overnight in the U.S. after a deal was not reached. And most indications would suggest both the automakers and in the U.S., the UAW, are still not close to being able to resolve this issue. What's unique, though, about the UAW action this time around, Paul, is that they have a fairly strategic president in Sean Fain. He likes to use social media to get his message out. And even the strike action we're seeing this morning, you talked about 13,000 people walking off the job. They are walking off at selected factories across the United States. I mean, there was upwards of 150,000 members overall. And this is very strategic. The goal here is really twofold. One is to target some facilities that in particular manufacture fairly profitable vehicles for these automakers, but also they want to make sure that they are not dipping too deeply into their own strike fund. So with this kind of new approach, it's hard to know where things go from here. And also, it's a bit confusing, arguably, to figure out how the Canadian story plays out. The Unifor union had decided, as they were approaching a deadline, that they would do a targeted negotiation, in this case with Ford, which was selected. And we've seen this, Paul, before, where one automaker is selected and you get a deal in place, and then deals start to come together with the automakers. The UAW did not do that this time. They basically were negotiating with everybody at the same time. So that part is unique. And the timing is unique here, too, because now that there is a strike action in the U.S., the Unifor union is still on the clock. Their deal with Ford does not expire until Monday night. So we spoke earlier with Lana Payne, who is the president of Unifor, who said they're going to be talking through the weekend to try to get to a deal. She said, though, the strike action in the U.S. does not ultimately impact the negotiations taking place here in Canada. Have a listen to what she had to say.
The Canadian and U.S. Auto industry is highly integrated. Currently, the locations that they're targeting in the U.S., the UAW is targeting, will not have an impact on Canadian operations. So far, that's fine. But you know, anything can occur given the strategy that the UAW is engaging in right now.
So I guess the point there being, we'll see where it goes, and we'll see how many additional factories are impacted and whether, in the case of Unifor, Paul, they can get to the finish line. But the numbers could add up very quickly, whether it's for the cost for the automakers or ultimately for the economy, with people already trying to figure out where the economic story will land, especially with recessionary concerns on both sides of the border.
John, thanks a great deal for this, keeping us up to date on one of the big corporate stories in the U.S., labor unrest and picket lines going up at 3 big auto plants in Missouri, Michigan, and Ohio today.